This is Matthew Cratter from Trade University, and today I want to talk about the DXY going parabolic, what the US dollar index is, why it's been rising, and also why this is bad news. So this is the DXY, also known as the DXY, the US dollar currency index. We can see that for much of 2022, it's been moving sharply higher, trading as we speak at new highs for the year. Just to put it in perspective, we can scroll out and see that we're really tracing out decade highs here. We haven't been this high since the early or the mid, I would say the mid 2000s. So this is definitely a significant move. It's one that a lot of people have been talking about. I wanted to talk about what the US dollar index actually is. What it is it's a basket of exchange rates measured relative to the US dollar. And the weightings are very much towards three main currencies, really two main currencies, the euro, the yen, so the euro versus the dollar, the Japanese yen versus the US dollar, to a lesser extent pound sterling versus the US dollar, and then Canadian dollar versus the US dollar. Very small weightings with the Swedish krona and the Swiss franc, but the two really big ones are the euro and the yen, and those are the ones we're going to be focused on. A lot of the dollar strength just comes from the Fed's hawkishness. It's raising rates, it's saying that it's going to roll off the balance sheet, and its general tightness of policy. If we take a look, though, it's only affecting certain currencies more than other currencies. So if we look at the US dollar versus the Australian dollar, we can see that the US dollar has been showing strength in 2022, but nothing really hugely significant. We can see here if the chart moves up, that's the US dollar strengthening. If the chart moves down, that's the Australian dollar strengthening. So we're seeing a little bit of US dollar strength against the Australian dollar. Likewise, against the Canadian dollar, not a huge amount of movement, nothing highly significant. Same for the pound, a little bit more of a move here. So what we're basically doing here is we're looking at the components of the DXY and trying to see where most of the move has been coming from. Here's a chart of the US dollar strengthening versus the euro. So this chart moving up means the US dollar is getting stronger against the euro. And as we said, we haven't been at parity, in other words, a one-to-one relationship in the US dollar versus the euro since December of 2002. So this is quite significant. Likewise for the yen really breaking out from the beginning of this year, really from earlier in 2021 as well, hitting 137 yen per dollar. So why is the yen so weak? We'll also talk about why the euro is so weak. Before we do that, though, just wanted to ask you, if you're enjoying this channel, if you're finding this video helpful so far, to hit that subscribe button and hit that like button as well. So why is the Japanese yen so weak against the US dollar? And as we're going to see, it's been weak against the euro as well. Basically, the main reason for this, and of course with currencies, there are a lot of geopolitical factors, there are interest rate differentials, there are trade flows, there's purchasing power parity, there are all these different inputs and important things. But I want to try to distill this and focus on the really big issues. The big thing that the Bank of Japan is doing, which is the central bank in Japan, is they are doing what's called yield curve control. You might see this abbreviated YCC. And what they're trying to do is to cap the yields on their government bonds, on their 10-year government bonds at 0.25%. That's not 25%, that's 1/4 of 1 percentage point. So we can see that interest rates are still very, very low in Japan, as they have been really since the bursting of the Japanese real estate and stock market bubble in the late 80s, early 90s. So why does the Bank of Japan need to try to keep interest rates down in Japan? They need to do this simply because the Japanese government has racked up so much debt that if interest rates move up too much, the government will be rendered insolvent and the central bank will have to print even more money. Japan has one of the highest, perhaps the highest, certainly the highest of all developed countries, debt to GDP levels, as we will see. In addition, Japan has aging demographics, has had very slow economic growth as well. Here's a statistic that people like to use to talk about Japan. Since 2011, sales of adult diapers in Japan have outpaced those of baby diapers. This is one graphic way of making the demographic point that Japan has a very, very low birth rate, and this has implications for the economy. If we look at debt to GDP levels, We can see that Japan is right up here above Greece. It's above Lebanon. Then United States coming in number 4 here. I think Venezuela technically would be higher than Japan. But if we're not talking about countries like that, certainly one of the major G7 countries having this high of a debt to GDP is unbelievable. And Japan has had very high debt to GDP levels for many years, and it hasn't blown up yet, but you never say never. So this is what's happening here. This is a chart of the Japanese government bonds, the 10-year government bonds, the yield on them. And we can see how for all of 2022, they've been trying to keep this at 0.25% or below. So whenever the yields spike above here, whenever hedge funds put pressure on them, trying to short them, the Bank of Japan comes in with freshly printed money, buys the bonds, drives up the price, and this brings the yields down. So that's what's happening right now. Yield curve control. As I said, you print up a bunch of fresh currency, a bunch of fresh yen, and you use them to buy these bonds. When you buy these bonds, the price of the bonds goes up and the yield goes down. And so you're able to cap yields at 0.25%. The only problem with this is you end up destroying the value of the yen versus real things, real goods and services, and also versus other currencies. Japan has been printing much faster and more than the U.S. has, and this is one explanation for why the U.S. dollar has been strengthening against the Japanese yen. So this is the price you pay. There's no free lunch in economics. If you're going to print up a lot of yen to keep yields low in Japan, you end up weakening the currency against not just the U.S. dollar, which is this chart that we saw before, and this is one of the major reasons that the DXY has been so strong, because the dollar's been strengthening against the yen, and the yen is one of the largest pieces of the DXY, the DXY basket. But the yen has been losing value versus the euro as well for 2022. This is what you call the euro-yen cross. And if this chart is moving up, it means the euro strengthening against the Japanese yen. If it's moving down, it means that the yen is strengthening against the euro. So the yen has been strengthening against the euro for the past few days, but for most of 2022, the euro has been, in other words, the euro has been less weak than the yen. So this is the best way to measure the relative outperformance of the euro or the yen. We see both of them weakening against the US dollar, and this is the main reason that the DXY has been so strong. But this allows us to show and to see that over the last few days, it's really been Japanese yen strength against the euro. But for most of 2022, the euro has been strengthening against the yen. Now, it's not a good thing to have a weak currency, whether it's the euro or the yen, when you need to import a lot of energy. And these are two regions of the globe, Japan and Europe, that both import a lot of energy. And this energy is mostly denominated still in US dollars. You still mostly have to use US dollars if you want to buy crude oil or natural gas. So this brings us to Europe and the euro. Why is the euro so weak relative to the US dollar? Well, one of the reasons is this energy dependency and the energy crisis that Europe is in and will continue to be in for the rest of this year, especially going into the cold winter. Europe has this big problem. Europe's private jet elite, in other words, the Davos crowd, decided to take energy policy advice from a Swedish high school student. They closed down their nuclear plants. They made themselves highly, highly dependent on Russia for some reason. And now they're really in trouble. And so people are asking these questions. Will Russia turn off the gas to Europe this winter, to certain regions of Europe, to all of Europe? Will people be freezing in their houses? Will Germany and other countries that have lots of manufacturing, especially very high-end technical manufacturing, will they need to idle their factories because they don't have enough energy to keep the lights on? These are the questions. If you can't keep your factories on, this is very bad for economic growth, and you end up entering into a recession. So a European recession is in the cards. It's probably already a fait accompli, and you combine this with high inflation, and you end up with essentially stagflation, which we're certainly seeing in the US, but I think you're going to see it even more in Europe. It's very difficult for the ECB, the European Central Bank, to raise interest rates in a recession. And so interest rate differentials favor the US dollar for now. So you have the Fed tightening, you have an imminent recession and a very deep recession coming in Europe. And so this means that at least based on interest rate differentials, the US dollar is favored. And it's usually the currencies with the higher interest rates that tend to appreciate, at least in the short term, or the currencies that have tightening central bank policy tend to appreciate against those that have policy that's less tight over the short term. So this is why the US dollar is another reason why the US dollar is appreciating versus the euro. In general, when you have a more hawkish Fed, this means higher interest rates, which, as we just said, means a stronger US dollar. Stronger US dollar tends to blow things up globally. And this one reason for this is you have lots of US dollar denominated debt worldwide. This is called the euro dollar market, basically offshore dollars that are not held in US banks. And what happens is when the US dollar strengthens, the people who have taken out this US dollar denominated debt, they need to continue to service that debt, in other words, to make monthly or quarterly payments, but it becomes much more expensive to get their hands on US dollars simply because the US dollar has been strengthening against all these different currencies. And so if I need to get my hands on US dollars in order to pay a monthly payment on my US dollar denominated debt, I sell my local currency for US dollars to service that debt. And in doing so, I get less US dollars simply because it's been strengthening against my local currency. In other words, my local currency has been depreciating against the US dollar. And this is what a hawkish Fed does. It blows up various parts of the world, unfortunately. And this is one problem with having a government-backed currency where you have a group of just a few people in the US that can have these huge ripple effects on the rest of the world and the world's economies. So if I'm holding US dollar denominated assets and I need to get my hands on US dollars to service this debt, I might need to sell some of those US dollar denominated assets as well to raise cash. This puts downward pressure on those US dollar denominated assets, whether they're US treasuries, government bonds, or US stocks. Also, most commodities are still denominated in US dollars, and so countries need to get their hands on US dollars, not just to service their US dollar denominated debt, their euro dollar debt, but also to buy these commodities. Now, this is slowly changing. Russia has begun to sell oil for euros or rubles or gold, depending how you want to see the different flows. Saudi Arabia has begun to agree to sell oil for Chinese yuan, for renminbi, to China. And so you can now buy some commodities without using US dollars, but the system is fairly slow to change. Now, what's going to happen with the Fed? We'll see what the inflation number is today, but the Fed will keep tightening until inflation eases or until something big blows up, whether it's a sharp stock market crash, whether it's the treasury markets freezing up. It's hard to say. Has the Fed become even more politicized under Biden than it was under Trump? This is a very good question because it was already very politicized with Trump putting pressure on Powell, and there's certainly enormous pressure on Powell now. Jerome Powell, head of the Federal Reserve, the U.S. Central Bank, huge pressure on him to bring down gas prices and grocery prices and put a stop to inflation before the November midterm elections, which is going to be very bad for incumbents if inflation stays as high as it is. The other question, of course, is the U.S. Treasury and the Federal Reserve, are they working together to try to hurt China and Russia with an extra strong U.S. dollar, using interest rates to strengthen the dollar? This was the speculation from Harold Malmgren that we talked about, I think it was a couple months ago, where he said that Yellen wants the DXY at 110. The only problem with this, it has been working against China. The US dollar has been strengthening against the renminbi, as we can see here for 2022. Hasn't been working against Russia. The ruble is actually stronger versus the US dollar. So if this chart moves down, that means the ruble strengthening against the dollar. The Russian ruble is actually stronger now than it was at the time of the Ukraine invasion. And this is really because Russia has all of these energy reserves, and that makes them in a very special position. And I think Putin understands this. We really do live in an insane world where you have an American central bank, the U.S. central bank, the Federal Reserve, and it can set this monetary policy. It's set by a few empty suits, a few ex-private equity guys and investment bankers, and a few criminals as well. And for example, we have the Christine Lagarde, of course, in the ECB, who's been criminally indicted. This is the problem with the current fiat financial system. You have central bankers, and you have these ripple effects from having the US dollar as the global reserve currency and its interest rates, and it's is all set by this group of very small, very few empty suits. This is the fiat clown world. Unfortunately, stronger US dollar probably continues to be bad for Bitcoin short term. You can keep Bitcoin down over short periods of time. Ultimately, though, the Fed's going to need to reverse. For now, we have the US dollar going up and everything else going down as the Fed turns more and more hawkish. What we're waiting for is the Fed pivot. When the Fed decides to start cutting interest rates again, some of the markets are already pricing in interest rate cuts in 2023. But when the Fed pivots and starts printing more money, buying US government bonds, buying treasuries, putting it on its balance sheet, growing its balance sheet, and cutting interest rates, all this money printing is going to be something like we've never seen before. It's always bigger. Each stimulus package, each monetary stimulus package is bigger than the preceding one. So 2020 was bigger than 2008, 2009, and 2022 or 2023. I still think that the Fed reverses sometime in August or September, but whenever the Fed does reverse, we're going to see huge money printing. The Fed, as we've said many times on this channel, has no choice but to debase the US dollar this decade. The Fed can't stop printing money because the US Treasury can't stop issuing debt. US Treasury can't stop issuing debt because the US government cannot stop spending, and it's unable to raise enough in tax revenues, even if it just started confiscating the wealth of billionaires. This is the fiscal problem that the US has, and this is the reason the central bank is going to need to print for the rest of this decade to basically monetize US government deficit spending. The US will certainly go the path of inflation and possibly hyperinflation, though we will have these periods, these volatile periods where we oscillate between everything contracting when the Fed tightens and then everything expanding again when the Fed starts the money printers. Unfortunately, we're in a position now where the Fed cannot tighten with debt to GDP levels this high. As I've said many times, if Paul Volcker himself came back, he could not raise interest rates to 10 or 20% without blowing everything up. When he was active in the early 80s, the debt to GDP levels in the US were closer to 30%. Now, as we said, they're closer to 124%. You cannot tighten with debt to GDP levels this high. This is the problem Japan's having as well, which is why they're trying to actually have to do the opposite. They're not trying to raise interest rates, they're trying to lower interest rates so their government doesn't blow up. And the US is in a similar position where we can only go with this Fed hawkishness and Fed tight policy for so long before everything goes down. And we've seen almost every asset is down in 2022 because of this. If you found this video helpful, be sure to hit that subscribe and like button. Hit the notification bell if you want to be notified when I publish my next video. And let me know your questions and comments in the comment section below. Thanks a lot for watching, and I'll see you in the next video.